Everyone. So today we're going to continue with July transactions, and we're going to work on a new sheet, which is called the worksheet. All these can be found in the file July transactions dated February 5th, 2019. I have it on the screen right now. You should be able to see it. Essentially, it starts off with what we call the unadjusted trial balance. If you look on these columns, this is all the accounts with balances at the end of July. These balances were created by making your T accounts based off of the transactions. The T accounts then get posted on what we call an unadjusted trial balance. And it's merely just taking your T accounts and listing your debits and your credits. If you look here, I have a file for the T accounts for July. So this is where all this information came from. And again, that came from your transactions that were posted. We posted by knowing we put an X there. So back to the worksheet. First column is the unadjusted trial balance. And it's just listing all the debits, all the account balances with debits on the debit side, all the account balances with credits on the credit side. And if you look down the bottom, there is a total. The total is just adding up both sides. This has to equal. If this equals, it means that you're on the right track, you did everything correctly. The next column over is any adjustments. If you look at the adjustments are from the adjusting entries. The one for prepaid rent, the one for office supplies, and the one for depreciation. So just like we did the journal transactions for those adjusting entries, which I will post on another sheet at some point, you want to list those adjustments in these columns. So we'll start with prepaid rent. Since we paid $1,500 in the beginning of July for 3 months rent, what happens is, hopefully by now you've gotten the concept of adjusting entries. So the idea of accounting and accrual basis accounting is that a company needs to show their revenues in months that they were received and expenses in months that they were used or incurred. So for instance, we paid 3 months rent in the beginning of July. On July 1st, when we bought that rent, we never used the property. So we didn't have an expense on July 1st. We were prepaying, so it becomes an asset. Because for some reason, we might want to move that rent. So the 3 months rent can be reduced. Sometimes you get offers to pay up front. For instance, you could have been told that your monthly rent for 3 months was $600 a month, but if you pay it all up front, we'll give you a discount and make you only pay $1,500. So that's what that's what Manor decided to do. It went with the $1,500 up front for 3 months. So at the end of the month, we have to then show an expense. So we have to make an adjustment for that. So our prepaid rent has to be credited $500. So that credit goes there because you have to think about it. Now that July is over, on August 1st, the value in that prepaid rent is only 2 more months because we used 1 month up. So that incurred a rent expense for the month of July. So then we go down to the debit and we have the rent expense of $500. Additionally, we have office supplies. We purchased office supplies of $500. Office supplies are an asset because it's information that we need in order to do business. It's assets. It's material we use that helps generate revenue. It's considered an asset in that case. So the asset is there for you to use. At the end of the month, obviously, we've used it. Think about office supplies could be paper, pens, any sort of material. If you're doing any sort of business, you're using that material, so therefore it's no longer available for you. So we're estimating that we used about $100 worth of office supplies. So we need to adjust for that asset being used by decreasing office supplies. In the accounting world, an asset decreases by crediting it. So we'll put $100 there. And now we have an expense. Businesses want as many expenses as they want because the equation for net income is revenues minus expenses. Businesses only pay taxes based on their net income. So if I can have a whole bunch of revenues up here that I can then show all these different expenses down below, the leftover is all I pay taxes on. So whatever I can do to reduce that net income helps me in the long run. The last adjusting entry we have is for depreciation. Depreciation is the value of an asset decreases. I put in the example that we purchased the equipment for $1,000. It has a residual value, the value left over after it's done being used, of $0. And it lasts for 25 months. And we're going to depreciate it every month. So the formula for depreciation is 1,000 minus the residual value, or purchase price minus residual value, divided by the number of useful lives. So it's 1,000 divided by 25, or $40. So we know right off the bat we have depreciation expense of 40. Now, to offset the depreciation, we don't take it against, like we do with other assets, where we're decreasing the asset. It always stays on the value of the asset always stays at the purchase price. So the equipment never decreases. It's always still $1,000 on the debit side. But to show that we are depreciating it, we're accumulating depreciation. So we create this account that collects all this depreciation. Accumulated depreciation is considered a contra asset account because it's an account that goes against the asset. So we're collecting all that, and in that case, it is increasing. But if you looked at the initial chart of account list, this was one of the start accounts that shows it does opposite of assets. It falls under the assets because it's a contra asset, but when it increases, it's a credit. So we're going to do $40 there. So our adjusting entries is very similar to our unadjusted trial balance, our adjustment columns, where they both have to equal. The debits have to equal credit. If we move over to the next column, we have this thing called adjusted trial balance. The adjusted trial balance is essentially now what happened. We have this starting point. We made the adjustments. How do the balances change? How is that affected here? So you look, so I have 44,100 starting in cash. I didn't do any adjustment in cash because you never adjust for cash during adjustment periods. So my adjusted trial balance for cash is still 44,100. It doesn't change. I now have to add this $40 on this side. Accounts receivable doesn't change. Office supplies doesn't change. I'm sorry, office supplies does change. I have $500 unadjusted, debit. I'm going to credit $100, so that makes a new balance there of $400. I'm just going to change the view of this to get rid of that page there. Hopefully that helps make it a little bit cleaner. There we go. Prepaid rent, similar. Started with a $1,500 debit balance. I credited $500 in the adjustment, so I am left with $1,000. The general rule of thumb is if you have a debit on the unadjusted, a credit on the adjustments, you subtract. Or in other words, if you have two different columns, you subtract. The columns are the same, you add. We made no change to the notes payable, no change to common stock. Dividends is still $500. Revenue is still $11,500. We have our $400 utilities expense, and now we have to add in all these other expenses which were adjusted for. I caution because I see every semester, every time we do worksheets, there's a common mistake that occurs that we have all these adjustments for expenses, and for some reason when they get carried over to the adjusted trial balance, people put them on the credit side, and it messes everything up. Keep in mind, it's the balance here. So if I have a debit here, I stay debit. As you can see, we're back balancing again. So the adjusted trial balance, both the debits and credits have to equal. If we move over to the next column, we have the income statement here. The income statement is exactly how that financial statement looks. By now, hopefully you know that the income statement shows what the net income for the business is. We just said earlier that the net income is revenues minus expenses. So in this statement, you want to put all those accounts that are revenues and expenses. So it's from service revenue down. So we'll just copy those. The balance sheet is the financial statement that shows your assets, liabilities, and equity accounts. So it's from cash down to dividends. So I'm just going to copy those over. If you notice, those debits and credits don't equal. I have 1040 on the debit side, 11.5 on the credit side for income statement. They don't equal because the concept of the income statement is to show where the company made, if the company made an income or a loss. At this point, nothing in the accounting cycle showed if the business made any money. It recorded the revenues, it recorded the expenses, but it didn't determine whether or not the business made money. The only place where you see that determination is on the income statement. So it's obvious then that the income statement should not balance. The credit and debit sides can't equal because you have to show something, whether the company made money or lost money. The idea behind that is, I mean, it could equal, but that means the company broke even. There was no profit, no net income. In this case, we can see our revenues were greater than our expenses. So we do have a net income of $10,460. On the same thing, the balance sheet shows the assets, liabilities, and equity. If you recall from previous lessons, the concept of retained earnings. So if the business made $10,460 for the month of July, what did the business do for that? Businesses can do two things with income. They can either pay it out to the owners in the form of a dividend, or they can keep it as retained earnings. So you made this income. The balance sheet needs to reflect what you did with that income. The balance sheet in this column is slightly different than the final financial statement balance sheet, and we'll work on that in a moment. Actually, you might be working on that on your own, so sit tight. The balance sheet here, for now, you just take the debits and credits, and you see that the debit sides are off the same amount as the net income. That's the key thing. Debits and credits don't equal on either income statement or balance sheet, but they should be off by the same amounts. And in this case, they are $10,460. Before we move on to this last step, it's called post-closing trial balance. We have to do something called closing entries. So we've mentioned at some point during the course of the semester that there are two types of accounts, permanent accounts and temporary accounts. Expenses and revenues are temporary accounts. Essentially, temporary accounts don't hold balances. They get closed after every period. Assets, liabilities, and equities, those accounts that show up on the balance sheet are permanent accounts. At the end of each period, you have to create closing entries. So what that means is you have to close your debits, you have to close your revenues and expenses. So I'm going to start a new tab here, and we'll close our revenues and expenses. Just making some notes so I remember the amounts. Okay, so if you notice, so up here we're going to start our closing entries. And we're going to do these on July 31, 18. So our revenue showed a credit balance going back. I have service revenue showing $11,500. In order to close an account, we have to get it to a zero balance. Okay, so the only way that we can get this service revenue of a credit $11,500 to equal zero would be to debit it $11,500. So we're going to go back over here, and I know I'm going to debit service revenue $11,500. Double entry accounting requires every time you have a debit, you must have at least one credit. So for every one debit, you must have at least one credit. Essentially what we're doing here, if we go back to our worksheet, we see this income statement. We're trying to summarize what the income is. So we know we have a net income, but where does that go? How do we do it? So in accounting, we create a new account, which is really a temporary holding account called income summary. Income summary is an account that essentially holds revenues and expenses. You close your revenues, expenses to this account to summarize the income. Again, accounting's not creative with their names of accounts. It's a summary of the income. It's called income summary. So I'm going to credit income summary, $11,500. And then I'm going to do on 7/31, and this is, let's make a comment, closing revenue for the month. I have to do the same thing for the expenses. So we have utilities expense, depreciation expense, rent expense, and office expense, office supplies expense. Those total $1,040. They're on the debit, so in order to close them, I have to credit them. So on this side, I'm going to debit income summary this time. $1040. And I'm going to credit the expenses. So I have utilities expense, $400. Rent expense, $500. Let's fix that. Office supplies expense, $100, and depreciation expense. $40. So I'm going to just do one thing here. I'm just going to copy this T account over. Put this over here for a minute. And I'm going to change the name of it to income summary. Effectively show you what we've done. So if I were to create a T account, I would show I have $11,500 here, and I have $1,040 here, right? And we know that this account summarizes income. So in order to show what the business does with that income, the last account I need to close for the revenues and expenses is income summary. Before we do that, let's make a note here. This doesn't close revenue, it closes expenses. In order to close income summary, I have to get a balance. So if I were to balance this, I would subtract the expenses from the revenue. And I believe that number's what? 10,460, is that correct? Let's look on the side over here. 10,460. So if my balance is 10,460, I want to close it. It's on the credit. So in order to credit that, in order to close it, I need to debit it. So over here, I'm going to do 7/31/18. I'm going to debit income summary, 10,460. Now, we mentioned earlier in this video, what does a business do with their net income? They either can pay dividends or they retain it and retain earnings. So right now, we want to show we retained what the income is. So right now, we have $10,460. We're debiting that. We need to put it somewhere. So we're going to retain it and put that in retained earnings. So I'm going to credit retained earnings, 10,460. I'm going to create a T account for retained earnings. If we go back on our worksheet, since we just started in the business, our retained earnings does not have any balance. So I'm going to put in there this credit of 10,460. Now, Is that the true picture of what Manor Corporation did for the month of July? Let's go back and look at our worksheet. If we look at our balance sheet, we have this account here with $500 in it. It's dividends. So that says that Manor paid its owners $500 of the income. So we don't have retained earnings of the whole $10,460 left over because we paid out dividends to the owner. So what we want to do is the last entry we have to close is dividends. So we'll put here close income summary. And now we want to close the dividends. If dividends has a $500 debit, we need to credit it. That dividends comes off of income that we kept or retained, so I need to decrease my retained earnings by that $500. So I'm going to debit retained earnings and credit dividends. Let's fix these guys to make them non-italic. 500. 500. If I take that 500 there, my new balance in retained earnings is now the difference, which is 9,960. Okay. And this close dividends. So let's go back to our worksheet. So since we just performed the closing entries, we now can create our post-closing trial balance. We're going to start with all these accounts. Assets to common stock, nothing changed. This now has 0 in it because we closed it, so it doesn't have anything, but we now have retained earnings of 9,960. I did my math right, which it looks like we did. My debits equal my credits, and therefore we balanced. So this completes the accounting cycle. So we have our complete worksheet, which again started with our T account balances unadjusted. We then made our adjustments. We did the math to get to the adjusted trial balance. We used the worksheet here to show what the income statement would be, which is our revenues and expenses. And we showed our balance sheet, assets, liabilities, and equity accounts. From there, we closed the entries, closing out revenues and expenses and dividends in order to show what we did with any income earned. For our purposes, we retained $9,960. That shows up on our post-closing trial balance. And from there, you have the starting point for next month. I hope this helps. There will be some additional PowerPoints and some videos showing more on closing entries and stuff. Talk to you guys soon. Have a good day.